as earnings season winds down, there is one magnificent seven stock left to deliver their quarterly earnings. NVIDIA, of course, is on deck to report first quarter results. That's going to be later this month. Investors are waiting to hear from the AI darling after collecting insight from several companies on their AI efforts. For more on the key trends this earnings season, let's get to Innovator Capital Management Head of Research and Investment Strategy, Tim Urbanowicz. Tim, it is good to see you. So maybe we can start there, Tim. You know, earnings season, just interested to get your take, Tim. What have you learned? What have been the kind of key trends, themes, takeaways for you?
Well, Josh, it's been a very strong season overall. We've seen very good growth at the index level, and a few key trends that we have been paying attention to here recently. Number one, we've seen very strong margin growth across the board, really across most sectors. Particularly, we've seen it very strong within the technology space, communication services, where companies are expanding their margins, they're growing the bottom line, which I think is very encouraging. And if you look at what we saw throughout the quarter, we had a quarter where growth remained firm and inflation really accelerated. And what we tend to see is that as inflation accelerates, you tend to see margins grow. And that's exactly what we're seeing right now. We do have to be careful moving forward. Everybody wants this inflation narrative to get under control, but that also might mean that, moving forward, you could see those margins come down a little bit. That's not our view that we're going to be in that environment, but if we are, you need to look out for that.
Tim, what's also interesting, we were just talking about Palantir as one example of the AI trade and companies that are giving more and more information about AI and how it's affecting their earnings. What do we learn in the earnings season with regard to the AI trend?
Well, Julie, when we're talking with investors right now, one of the key themes that we are continuing to reinforce is that this is not a trend that you want to fight. Companies are looking to integrate, they're looking to scale. And right now, we think it's really all about the infrastructure build out. So thinking about things like semiconductors, data center REITs, cloud companies, they're going to be critical for that integration. And even if we see a downturn, I'm not so sure that you're going to see that pullback in spending just because it is so critical for productivity longer term. So we think that theme is really important. It's been a key driver of the market throughout the first several months. We think it's going to continue to be the key driver over the next several months, specifically with that focus on AI infrastructure and building that out.
And Tim, I'm interested what you think just broadly what the next catalyst for the market is. Tim, we did get some, recently those good data points, right? So you saw that jobs report, okay, cooling but not crashing, and earnings coming in better than expected. Apple reports and pops, and Jay Powell just told you unlikely the next move is a hike for sure. Is that enough for a catalyst, Tim, to move the market higher?
Well, it's going to be interesting, Josh, and I think we're going to continue to be in this environment where investors continue to over-extrapolate information from little data points like we saw last week. No doubt that was encouraging, seeing the softening in the labor market. Wage growth started to cool a little bit. That ultimately is going to hold the keys, but we need to remember that this is just one data point. We need to see that continued trend to really get this battle under control. So what we are talking about to advisors right now that we think is probably the most critical thing in their portfolios is you have to find ways to decouple risk management needs from the reliance on interest rates coming down. You're going to continue to see big volatility in rates, as we were just talking about earlier. And that means really decoupling, separating those risk management needs from the reliance on interest rates. We're seeing a lot of clients in our world gravitate toward options-based strategies. Buffer ETFs is one example that we're seeing a big move in. And we think that makes a lot of sense, just given that you have the built-in risk management. You don't need to rely on long duration bonds. You're not relying on low volatility stocks, defensive sectors like utilities, which at the end of the day, Josh, are all beholden to interest rates having to come down. It's not what we want. You got to separate those two.
And so in other words, it sounds like not necessarily a more risk-off environment, but maybe a little bit more risk cushion or risk-averse environment than we've been seeing over the past year or so.
Yeah, well, what we're saying right now, Julie, is we want to be risk aware, right? We want to be aware to the risks out there. No doubt we're towing the line, right, between getting inflation down and the recession, right? We got to walk that straight and narrow path. But our base case view is that you're going to continue to see a world where economic growth remains firm and inflation remains firm. And that is a world that I think you can continue to see equities do very well in overall. Talked about on the front end, inflation goes up, you tend to see margins go up. Growth remains firm, that tends to drive the top line. And at the end of the day, you can look at all the economic data you want, but earnings are what drive stock prices over the long run. So we think that's actually pretty favorable for equities here moving forward.
Tim, I'm just curious too, switching gears a bit here, how you think about geopolitics. I ask because we are seeing these headlines drop. Israel did begin hitting targets in the southern Gazan city of Rafah, Tim. I'm just interested, you know, as a strategist, you're talking to clients. How do you just think through these kind of geopolitical dynamics?
Yeah, well, we think about how we manage that risk. And obviously at the index level, buffer ETFs, we continue to see as a very viable solution to help manage that risk. I also see we're talking to clients a lot about integrating energy into their portfolios. Energy is one of those sectors right now, Josh, that's trading at about a 40% discount to the broad market. It's very cheap. And it also offers a very nice hedge to a lot of those geopolitical tensions. And by the way, a lot of those macro tensions that we were talking about earlier, if you continue to see that reacceleration in inflation, it's obviously something that no one can predict. So it's important to have that built-in risk management in place, and also look to those pockets of the market that are underappreciated, but all for nice defense.
Tim, thanks a lot. Good to see you.